Okay, welcome to the Boxcar Trade weekly meeting. Today is the 16th of August, 2022, and it is National Airborne Day. My neighbor across the street was a retired Army Special Forces for 20 years, and I'm sure he jumped out of a lot of airplanes. So hats off to those guys for what they do. Me as a pilot, I always thought, why leave a perfectly good airplane? So two different trains of thought, but I'm sure it's fun to do. So
Well, that was always the joke. I used to skydive many years ago. I had, I think, 250 jumps or something like that before I gave it up. And yeah, it was a lot of fun. And I learned to do it in the Air Force, actually, but not as a part of the Air Force. It was in a club, and
okay.
I learned there. And so I jumped out of Hueys and also several different kinds of private planes. It was a lot of fun.
Yeah, we live about 3 miles east of the Air Force Academy, and we see a lot of flying activities. You can imagine, mostly small airplanes, but then every once in a while you'll see the Air Force Academy jump team out there with their parachutes. So it's kind of fun to see. Um, okay, normal disclosure: the Air Marine is not a broker dealer, investment advisor. It's for educational purposes only. Options, futures, currencies involve risks, are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole disclosure, pause the recording and go to the bottom of any of our web pages. And just attribution for all the providers that we use to help us be better option traders. Okay, so overview, quick performance. I don't know if I have any announcements or not. I don't think so. We'll go over the spreadsheet, current market, open trade, and discussions. We had one of the subscribers write in and ask about defending against a big move down initially. So the spreadsheet update, right now it automatically calculates the target exit dates. I know, Dan, you gave me that idea the other week. So these target exit dates, I just take half the time in the trade. So it puts this to today, divides by 2, and figures out a target exit date, and then copies it to the dashboard. So right now we're a week out on the current trade that I opened yesterday. Oh yeah, I did a walkthrough video, and there's a link to it on the spreadsheet, and also on the page where you download the spreadsheet. So let me see if I can find that. That's this page here. So this is the page where you download the spreadsheet. Now there's this walkthrough video. So if you're new or you want to see what's going on with the spreadsheet, it's actually, I think, about a half-an-hour video. So I walked through it pretty detailed, but it's there if you're new or just want to see what's changed since the last time you watched it. I also added another field called average theta per day. So on your SPX and SPX 1 and 2, this is trying to give you an idea of how much money you can make per day on average based on the remaining credits. So on the last trade I had, when I had like 3 lots down and they were trading for like 20 cents, this was like 10. And you're like, well, I could put a new trade on and get, upwards of 50 to 100. So that's a good indicator. Just, how much are you realistically going to make with theta per day? So I added that one in there. And then there's a what if adjustment. So now, say for instance, you think, okay, what would my P&L be if I close this for 75 cents? So you can go minus 0.15 or maybe 0.15. Oh, I guess the spread price changed. Or I didn't do minus 0.15. So now if the spread was at 75 cents, this position would be up $247. Right now it's current 90 cents. It's a 141. But you can use this, the kind of what if I close these spreads for this price, what would my P&L be for the position? So that's kind of just a helper to figure out what price you want to try and get and what profit you'll have. And then a credit remaining column on the dashboard. Okay, so that's this one. Okay, so that's the credit spread credit that's remains. So that's actually this one right here, but it's on the dashboard, so you can see that at a glance now. So those are the updates to the spreadsheet.
Those are all very nice features, and I think they're really important because a lot of newer traders don't seem to, there seems to be a disconnect between, how much money is left in the trade that they can make if everything works perfectly, and also how much they're making per day. There's a disconnect between those and their decision-making process of whether to stay in. And like you were saying, if there's not much left in the trade, you're going to do a lot better off just to close it, take whatever profit you have, or if it's a loss, go ahead and eat your loss and put on a new trade.
Well, it's like that saying, picking up pennies in front of a freight train. When
Yeah.
you get to the point where your spread's worth a dime or 15 cents, but you've got $24.85 of risk. Okay, it's pretty far away, but a 1987 can happen. So, just close it out and put your money to make where it's making more efficient use of that capital. Okay, so performance, these are the recent closed trades. So doing on a pretty good roll here. Just the one loser in July. And then the current markets, actually that's, I pulled this up the other day. Let me just pull up a real live chart. So this is live. I'll do that. Yeah, so we get the ease of movement. And here's a daily chart. So we've been on a really nice nice run here. It looks like the market's in pretty good bull mode, but it is on a bigger picture, say a weekly chart. It's kind of a bear market rally, but is this the bottom or not? It's hard to say. Wayne's models from the sleep well portfolio, he's thinking we're going to go higher a few more weeks, but then Q1 and Q2 of next quarter, it's just going to dump. So if Wayne's right, this is a bear market rally. If he's not, then this could be just the low, and we're heading back up towards the new high area. But in any case, for us, we have a much shorter time frame, and these rallies are nice. Even the consolidation sideways is good, as long as we don't get this kind of thing where we were down 10% in a week. That's tough to deal with. But we do have ways, and we're going to talk about that a little bit later. So the open position right now, when I took the screenshot about 20 minutes ago, we were up 167 bucks. Let's take a look at it right now. Spreadsheet. Okay, so this is bouncing around. So we're 31 points off the low, 3 points off the high, and so up $141. I rolled up the debit spread, and I updated the spreadsheet for you guys, so that's ready to download. So I've got a 5-wide debit spread at this point with a 25-wide 6-lot credit spread, and an option view, it looks like this. So the position delta is just around 6, which is perfect for a 6-lot. The delta of the short strike, we're getting close to 2 standard deviations away at expiration. It's at 6.3, so that's I think I put it on about 10.5, so it's come down quite a bit. And at this point, it's looking fairly safe. I'll probably leave this debit spread on for a little while. We're still 11 days out, so I'll leave that on. And then I've also got a contingent order. If you go to the position page, you can see that. So and I'll probably adjust this price later today. But if the SPX gets down to 42.44 roughly, and we're at 43.08, so pretty far away, about 65 points, then I'll put another debit spread on. But this is where we are right now. I really like this format. It's got all this good information, the logs. I still have to record a video. I was in training group 1 when I did this last adjustment, so I haven't had time to record a video yet, but everything else is current. And if you need to put your conditional order on again, you can just click on here, and I must not have the what is it, the trade ID. Hang on a second, I'll fix that. So I go trade messages, and there's actually the trade message ID, and I need to connect that to the trade conditional order right here. Okay, so now when you go to that positions page, it should just pop it up. Yep, there it is. So just copied it to the clipboard. And all the trade messages can also do that too. So if we go to the trade messages page, if you see the little TD link, you won't see this TMID, the trade message ID, but you'll see this icon. And if you, any order that I'm having, you just click on it, and that just copied it to the clipboard, and you can paste it into Thinkorswim. So it's a much faster way than even just going, copy, paste, and all that. Just go click, and it's done. So anyway, that's the current trade, looking pretty good. And
What were your adjustments on that trade?
I started out with a 42.55, 42.40, I think. Let me look. Let's go back to the positions. It has the whole trade history. So I did the 42.40, 42.60 debit spread. And then yesterday I rolled it up 5 points. The market, I think we were about 25 points above where I entered. And I wanted to just tweak it a little bit. So I got brought in $1.60. And then this morning I rolled that 45 strike up to 55 for a 280 credit. So I've just basically just the long strike stayed the same, but the short strike's just been moving up and just lifting this up. And basically the thing that's guiding that is the position delta. The position delta this morning got down to like 4 something. So, we had a nice little rally going on, and the short strike delta, the credit spread, is in a nice shape. So I figure, well, I don't need as much protection on the downside quite yet at the moment. So I just, just rolled that strike up 10 points for a credit. And let's see, somebody raised their hand. Eric raised his hand. If you have a question, just put it in the chat, Eric. So that's basically it for this trade. And where's my PowerPoint? Okay, so for the current trade, it expires on Friday the 26th, so a week from Friday. We just looked at all the live data, the position delta, the credit spread, short strike, and the distance from the current market price to the short strike is 231 points, or 5.37% away. So it's a good distance. And the economic events, we have retail sales tomorrow morning at 8:30. So that's about an hour before the market opens. And then FOMC minutes at 2 p.m. Eastern. Now the minutes are released 3 weeks after the FOMC announcement and the Fed chair briefing. So we've already heard what they said. This is just like the details of what they actually said in the meeting minutes. So the wording might be interpreted certain ways from the market, but overall, we already have the big picture information. So I don't think it's going to move the market a lot. The FOMC announcement is going to be the one where you have bigger movement, I think. But that is coming up tomorrow. And we talked about the existing position. So discussions, somebody wrote in and asked about extreme market moves down after launching a new trade. So some of the ideas is buy one of the credit spread short strikes in, and that would look like this. So if you just bought one of these guys in, that basically turns it into a back ratio. And that takes your delta from, let me make this wider, from 6.9 to 0.33. So it really flattens you out in a hurry just by buying that one strike in. Let's see. So that's one idea. Another one is buy a single long put to neutralize the delta. So in that case, you can take a look at what is my delta and what do I need to get it down to. So here's 6.6. So actually that would be the one you would need to buy. But if your delta got up to say 9, then you would probably want to buy this one. Now this would actually give us a -3 delta. But at the time, if you had a +9 position delta, that would be the one you're looking at. So basically, you just pick the put that neutralizes you, just to flatten things out. And go back to this. Other one is close the trade if the underlying price hits halfway. So this is an Amy Meisner technique. So basically, you take the price that SPX was when you entered the trade, and the price of the short strike on your credit spread, and you just take that midpoint between those two, and on the spreadsheet it calculates that for you. And that price for this trade for me is 41.71. So if we look at the chart, actually go the other way, 41.71 is about here. So if you get down to this point, then you're really struggling. You're fighting this trade a lot, and 41.71 is what, about 135 points below where we are now. So if you move this up 135, oops, that would be what, 42.10. So your short strike delta would be around 23. So yeah, you probably would have made adjustments by then. But that's kind of a line in the sand that Amy used as far as when to get out of a trade. Okay, so Eric asked, could you buy put 2 or 3 days more expiration, less hurt by theta? You certainly could. It's not going to be as big a delta, but you definitely could do that. And Greg, I did enable the chat, so that's good. Okay, so we were back to if the trade hits halfway from your initial entry price, okay. And then the other one is if your max loss is hit. So that would be, we have a max loss of, I think it's defined at 5%. I use 5% of planned capital because I base all my yields off of that, but you could use 5% of margin. And this calculation actually is of the max margin that you've used. So if you hit 5%, that will be $698 in this case. And yeah, so that's of the max margin. You could do it of planned capital like I do, but you got to have a line in the sand. And I got burned on this in June. I kept fighting it. And that comes, I guess, to the next point of this discussion question is, when do you stay in the trade, even if you've hit one of your exit criteria and you're beyond max loss? So what I was looking at for that trade is I had flattened this T+0 out, and we were under the tent pretty well. We weren't close to any, we weren't close to getting a hit on the short strike of the credit spreads. But volatility had exploded and the trade was massively underwater. So Dan, what do you think about staying in even though you've hit your max loss? What are your thoughts on that?
A big negative on that one, simply because of expected return considerations. Remember, everybody, whether or not you actually keep a table to calculate your expected return, it is still it's still happening, and one big loss is going to nearly sink you. And that is one of the problems with utilizing the adjustment where you take it off at the halfway point. I mean, that should be viewed as an absolute fail-safe.
Right.
And as a corollary to this, let's say that you put one on and you did not have the luck of the Irish and the market dropped quickly and you're already being forced to do something. You've already added another debit spread, and now you're more than 3.5% down, and you're thinking you might go on down to your maximum loss. You should probably just not fight this one. You should probably just take it off, because you've only been in it a couple of days. And even if you stayed in with the same cycle, there's lots of time now. There's time to add the credit spreads, even like with only 4 days left. Like, for example, I added one yesterday for the August 19th cycle. So there's lots of time, but once you take a maximum loss, you got to remember, now you're probably going to have two pretty good winners to make up for your loss. So I have been burned by that so many times over the years. And finally, the concept stayed with me, and I no longer do that.
Well, and
You
as an
just need to,
example, here is that loss I had in June, and I was trying to fight it, and basically it was going down with the ship, and it's taken until now to basically get back to where we were before that June trade. So, you will recover, but you're giving up a month or so of profits to do that.
yeah, and that's the way that it usually happens. Actually, that example is true to form, true to life. That's exactly what happens. So basically, for a couple months, you're just not making any money compared to what you had. You're just getting back to the break-even point, and now you're ready to take off. But why go through that? Why
Yeah,
not
just cut the
just,
loss.
yeah, just take your lumps. If you want to wait a couple days or a day to see if it stabilizes, but even if you decide to get back in right away, remember, Tom, you and I have said this before, that at the time of trade launch, you have a perfect trade.
Right.
So if you're out and you decide to put a new one on now at that moment in time, that is a perfect trade. And this same concept, of course, extends to day trading, or really to any kind of trading.
Well, I always like to ask the question, if I didn't have this trade on, would I put my current trade on?
Yeah.
And if it's getting ugly, probably not.
If
And
the answer is no, then no.
like this trade, I was hitting my max loss, so I cut and run. I said I'm out. And I lost $700, but the next day or next trade I made 500, and so I made it all back pretty fast. But if you take the big hit, then you're digging a big hole you have to get out of, which I did, but why go through all that?
Yeah, well, that's exactly it. I used to have a graphic that when I was mentoring, that it was a picture of a guy throwing dirt, and he was in the bottom of a deep hole, and all you could see was the top of his head and the shovel coming up with dirt.
I
And
remember that.
yeah, that's exactly what you're doing. You're digging yourself out of a hole. And uh, that brings up the question of martingaling to try to rescue. Certainly you can do that in a small martingale. You might fix it up, but you have to remember things can still go bad. Things can go very badly very quickly, and a martingale may come back to bite you. I just think, just as a general principle, when things start going badly, if it can't be fixed up very quickly and easily with a reasonably good chance of success, you're far better off to cut it and either launch a new one at that point, which will be perfect, or wait a bit. And that's a very painful lesson to learn, but the hole that you're digging yourself out, instead of a deep hole, it's just a small hole that you can easily recover from.
And Richard asked, what's a martingale? That's basically where you're increasing the size of your bet to, say you bet $1, lose $1, and then the next time you bet $2 to try and win, and then you're back to break even. But if you lose again, now that you have to bet $4 and then $8, so it's a power of two. That's in the betting world, but the way Dan's talking about it, say you have a 6 slot like I do, you cut and roll that, but now you sell an extra 1 or 2 to help pay for that loss that you just locked in. I built in, actually on the spreadsheet, it's user definable, the martingale percentage. So I add a 25% martingale buffer in. So I'm using a 6 lot times 2,500 is 15,000 margin, but I add 25% of that, which is why you'll see the planned capital of 18.7, because it's got that buffer built in to give me the ability to martingale without busting my planned capital.
And you could also do a risk reversal to stem the tide, so to speak.
Yeah,
But
for
again,
sure.
which is, reasonably safe to do. Of course, you can be burned on a risk reversal if the market, reverses immediately, but still that will tend to fix you up. I think one of the main principles out of this is to get your delta flat again, because as long as you have a reasonably good positive theta and your deltas are nearly flat, at least you're not in trouble. And if there's enough money left in the trade to justify your staying in the trade, as we talked about earlier, then you're okay. But if you're sitting there and you look at the expiration line and it shows $50, why are you in that trade? Just take your loss and put the money to work elsewhere.
And one thing that can get a little uncomfortable when you get in these situations with a big market decline is if you have, like, here's your 0 line. I'll change colors here. You end up with a position that might be, a couple of debit spreads, something like this, and then some risk down at the bottom. But your T+0, your T+N lines, you might be underwater like this, and then like this and this. So you're basically, you're trying to ride the top of the ball here. So as the market moves up, you have to do something. As the market moves down, you have to do something. It's not the most comfortable place to be in a trade, when you have to make adjustments to, if the market goes different, both directions, and any kind of significant amount. So you're just kind of riding, you're like a ball on the top of a balloon or something. You just have to keep, it's very nimble. It's very stressful too to do that.
Yeah, and if you are in that situation and you decide to try to ride it out, you're going to have quite a few contingent orders to take care of movement on either side.
Right.
And so I think for most traders, after you've done that 2 or 3 times, some people like myself are more stubborn or perhaps more stupid, and you keep on trying it, but it still doesn't work. So,
and you lose a lot of sleep too.
Yeah, I mean, every now and again, you can, just like if you have a conventional butterfly, when I was mentoring, I used to tell I used to use the phrase to my students, beat it over the head, beat it into submission. And what that meant was, continue to add capital, meaning new butterflies, until the trade finally paid off. And that's a little easier with the traditional or even a broken wing butterfly than it is on a simple credit spread kind of trade. But you can do it, but you have to ask yourself the question again, is it worth the aggravation? And secondly, could you put this money to better use elsewhere?
Absolutely. Also, the stress level too. I remember Scott Rubel had a story when he was new in the pits, and he had a position on the market was making a big move to the downside, and he was really stressed out and had a hard time thinking of what to do. And his mentor just said, "How much? What's your delta?" And he told him, and he said he just made a phone call and shorted that much stock or futures, and now he's instantly flat. He's like, "Okay, now you can think about what you want to do." And
Yeah,
without any
good.
stress,
Yeah, good advice.
because it is stressful, and Robert Chastain, who also works with Scott, has a phrase he likes. He calls every trade as a kill switch. So what trade can he add to his current position to completely neutralize it? Again, to give more time to think and decide, do I want to keep doing this trade? Do I want to close it? How am I going to attack this? So there's some value in not having a lot of stress, so you can think clearly Because when the market's going down and your delta is crazy and you're losing money, you start to panic and you're maybe not making the best decisions. So try and keep your delta flat, like Dan said.
Yeah, well, that's exactly right. And that's the reason why one of the best, out of all the possibilities that you gave, that's, as far as I'm concerned, a complete list. I have not utilized any other means of adjusting these things, but out of the entire list that you gave, I think perhaps the best, perhaps I shouldn't say best, but one of the best is to buy the single long put to neutralize the delta. And remember, you'll be buying this above the short strike. So if the market continues to go down, that long put will be making money. And it will be improving your position, but at least up to a point. If the market rallies back, then you can decide what you want to do with that put. Do you want to convert it to a debit spread? If the market makes a big rally, do you want to convert it to a small credit spread? There are lots of things you can do with it, or you can simply take it off, of course, and your original trade is still working. And if you haven't given up too much money, you are nearly where you were to begin with. So I think that's a very effective one. And it's easy to calculate the delta. Just, I mean, you know what your position delta is. It's like Tom said, if you're long delta and you want to get down to +2 delta for the position, you simply buy a 7 delta put, right?
Right. Simple. And one nice thing about that is, if you buy a put up here, this put is going to be getting more negative delta faster than this one is. So this will actually be helping you, like you said, pretty well.
Yeah, exactly.
Okay. How are your trades doing, Dan?
Well, I only have one on, actually. I was going to try to get one on today, and obviously I should have earlier this morning when we were down a bit, but I was day trading and missed it. So I have one on. It's up. I'm looking at it now. It's up 1.9%. Not a big winner, but a winner. And I've got $113 left on the put credit spread, so I'm going to maybe try to get a little bit more money from it, and then
What
I'll be out.
expiration cycle is it?
This is the 19th.
Okay, Friday.
Yeah, this is the one that I mentioned yesterday. I rolled up the put credit spreads.
All right.
And so this was the point I was making. Even if you only have 5 days left, very frequently you can still, and when I rolled those up, they were, I think, a 6 delta, I think, for the short strike. And now it's a 2 delta. It's the 41.25. And so, but yet, it had $450 of credit. So that turned my position. Yeah, so that turned my position around. The position was flat P&L wise, and now it's going to make $350.
How cheap do you let your credit spreads get before you close them, or do you ever let them go to expiration?
Oh, I have, but generally, obviously, it depends on the time. Like the example I just now gave, that a credit spread that I rolled up, it was maybe, I don't know, $15, $20 to get out of it. Maybe $30 to get out of it. But, to make 400, that's a no-brainer. But only if you look at your probabilities and your deltas and you're reasonably convinced that you can do it safely. And of course, if you're hedged, or even if you're not hedged, like on my current position, I actually do not have a debit spread in place. I will put one on if necessary, but since I'm up money, I might just, if the market started to turn on me, I might just go ahead and take my money again, like we were talking about, and be ready for a new one.
Right. And then there's a question, any thoughts on a butterfly version? Yeah, I had looked at that, but then I got COVID. And today and yesterday, I'm actually feeling 100%. So I haven't coughed. I don't feel bad. I feel normal.
Good for you.
So
How's Gabby?
she's getting there. She's not coughing quite as much. Yesterday was better. 2 days ago was really bad.
Hmm,
So it's she's not completely out of the woods yet, but she's definitely on the mend, as they say.
good.
But now that I've caught up with emails and everything else, I'm actually I have a guy, he's actually a computer science student at a local college, helping with some of the stuff on the site. I actually have a little bit more time, so I'll be looking at that butterfly version of the boxcar probably this week, and see what we can come up with. But that's
How
all
did you
I've got.
find that guy? Did you advertise or something, or did you just
Oh,
know him? Or
well, yeah, I knew him from, we use a service, Postal Annex. It's a post office box place, and he worked there. So we saw each other a lot and always talked about coding and what classes he was taking. And his dad runs the Fidelity office for Colorado Springs, but he would work there, except they have some rule against like the head off, or the guys at the top, they can't hire their families to work there, family
yeah,
members to work there.
yeah.
So he couldn't work for his dad, and we liked each other. We both like computers and programming and all that stuff. So he wanted to do something different, and I'm actually paying a little bit higher salary than what he's at with Postal Annex. So it's not many hours. It's like 1 or 2 hours a day, but every little bit helps. So it's he's a really nice guy too. So if you see Edward, that's the guy. Edward Russell is helping
Okay,
me out.
good.
Andrew. So anyway, that's all I've got. I don't see any more questions. So why don't we wrap it up, Dan? And oh wait, Eric says, Tom, try to flip your debit spread into a butterfly. I definitely could. Instead of closing it, you could do something like this and just lift this up a little bit. Let's just look at it with analyze, because then you can look at more than one thing. So that's with the butterfly. And then let's look at it if we just close it. And then another possibility to get a little bit more credit is set up a short butterfly. So let's superimpose all these. I'll get rid of the extra lines. Okay, so this is the current trade. Now, I like this on an option view, it has the expected return. So the expected return of the current trade is 434. If we just close everything, this green line, it's 420. And this one was converting it to a regular narrow butterfly, 374. So that knocks down the expiration P&L a bit. Now here's the expiration P&L. If you just close the debit spread, it's 720. If you convert it to a butterfly, it's 670. So it costs you $50 to do that versus just closing it. And then this one, we still have the delta hedge. You also want to look at the position delta when you're doing this stuff. So if we have if we close it, actually maybe I can just look at this thing. Well, that's not going to help, right? I need that's going to be too many lines. Okay, so if I close it, I'm going to have a 7.63 delta, which is a little bit more than I want. If I do the short butterfly option, it's still over 7, which isn't great. But it does lift the expiration line up to 725 versus this way, just closing it is 714. So I actually get a little bit more, which makes sense because you're selling the 60-55 spread versus a 65-60. So you're going to get a little bit more if the spread's 5 points higher. And then if you do just a regular butterfly like this, oops, you're basically selling the 55.50 spread, which is a little bit less. So here's your 705 versus I think it was 720 if you just close the spread. So those are some possibilities. You could also try and make it a broken wing butterfly. Now you could do something like this. That depends on how bullish you are. This gets it up to 835 for the expiration P&L. But if the market does pull back, you're still profitable, but not as much. But the bigger problem is the delta is now 8.66. So you've cranked up the delta a bit. So it depends on where you want to keep that position delta, really. I personally like it around 6, which is why I still have this 5-point spread on. As time passes, like say up here, the position delta, let's see, 2.86 versus today, 5.96. So you can see as time passes, even at the same price, your delta is getting smaller and smaller. So in a few days, this will get to maybe a 4 delta, and then I'll probably take this off completely. Hopefully
Yeah, and
that
you have
makes
to
sense.
weigh all those adjustment considerations against the addition of increased margin, and also there's an increase in risk, especially with that broken wing. I mean, I like broken wing butterflies, but when they go against you, it is painful. So you have to weigh all that, and you also remember that in option view, the expected return is a calculated value, and as I recall, the way they do it, they take the payoff curve, which for those of you who know the theory of all the probability considerations that we have, if you take the payoff curve, I think they take, what was it, 10 or 12 points?
I
Do you
think it's
remember, Tom?
20. I think they divide it up in 20 slices.
Oh, 20. Okay. Somehow 12 came to my mind, but if you say it's 20, it's
Well,
20
that's what I
anyway.
remember. I'll have to look it up,
Yeah.
but yeah.
Anyway, those are slices on the payoff curve. So it's a calculated value, and it does have, I mean, it's useful, but remember it's a calculated value and does not say that you are going to get that.
Right, absolutely, absolutely.
Yeah.
And also you can also define a target range. So so here's the current, this is with the broken wing, there's expected return. But you can say, I want to do this at the on a certain date, say 8/25, for instance. And then we'll go like to 4,200 to 4,500. And then it'll put this range that you've set in. Oops, I must not have done it right. Target. Oh, I had 4,200. That helps. Yeah, so there's the range that I asked it to look at, and it's adding up all the numbers in there and giving an expected return with a plus or minus, and then the probability of profit. So there's the bell curve. You notice that's 2170 because that goes all the way down to where you could potentially lose 15,000. It's a nice tool though. I like it. Now, as far as the margin for this, remember I've got 18.7 for planned capital. So this margin is 14,680. So I've got another $4,000 of margin. But if I start eating into that martingale buffer, if the market starts heading downhill and I need to martingale, I won't have as much capital to do that. So it's like Dan said, when you do this, you are bumping up the margin. And if you compare that, let's say let's do a side by side, that'll show both of them. Should both. Yeah, here we go. So here's the margin without the broken wing butterfly, 13,950, and with the broken wing is 14,680. So you can visually see here that increase in margin.
Yeah, and if if anybody's interested in looking at the probability of these adjustments, you can use the Monte Carlo simulator that Tom and I have talked about in the past, the option risk calculator, and that will draw the payoff curve for you. You want me to just show that briefly, Tom, or not?
Oh yeah, sure. Dan used this a lot when you were developing a lot of the different strategies, like the boxcar,
Yes.
the road trip, the weirdo. Yeah.
Yeah, and I used it for this one as well. I don't know if you can see my screen now.
I can. Yep.
Yeah. So this is the Monte Carlo simulator, and as far as I know, this is still online. I haven't used it in a while, but as far as I know, it's still there. At least I hope it's there. And but when it's easy to learn how to use. You basically plug in what you're doing, and it'll do basically any. I won't say any, nearly any kind of trade. And what you get when you do it right is you get um, the payoff curve, which is this one, which is the probability times um, the profit of whatever strategy you have at each of these points. And so it then generates a graphic display, which is called the payoff curve. And you can assess that against, since I had it backwards, the red one is the payoff curve. And you can assess that against the probability curve. And so for this particular example, this is one that I did, I don't know, years and years ago at a,
Looks like 2011.
yeah, 2011. This was many years ago at a seminar or something. But anyway, see, this is no good because your payoff curve, the red curve, sits well under the probability curve. What you want and what you'll get if you did this on the Weirdo or the boxcar, you would get the payoff curve. The red curve would be sitting out here. It would be sitting above the probability curve on the downside. And this is what you want, because that basically, just to put it into words, says that based on probability alone with no adjustments, you're more likely to win out here than you are to lose. Whereas in this particular case, the only time you're going to win is up in here someplace, just on a probability point of view. I mean, you'll win from there to there, but you have a probability that you might go all the way down there, in which case you'd have a tremendous loss. So this is a useful way to think about these things, I think.
Oh, can you back up one slide? I can get the URL.
Yes.
I'll go try it out. Java Linux.net option risk. Yeah,
And
it's still
then,
online.
yeah, okay, great. Yeah, and you simply plug in whatever you're trying to evaluate. And then if you're really interested, I won't spend any time on this, but you can, there's one additional thing you can do, and that is to get the percentile. And that's a useful way of looking at this. And we did this on the road trip, I believe. This is what we used for a while, wasn't it, Tom? Yeah.
Yeah, I think that sounds familiar.
Yeah, to get the percentile. So it's kind of a handy little tool, and it uses the prices that you put in and the expiration date that you input. What it does not do is take into account any adjustments, but that's actually useful, because what it is telling you is just on probability alone, with no adjustments and no addition of capital and no decrease in capital, leaving the trade alone, doing nothing, what are your odds of success? And that's some useful information. So as Tom said, when I was developing the Weirdo and the boxcar and some butterfly strategies that I've done, I always use this. I haven't developed anything new, which is why I haven't used this in a year or so, but well, I guess more than a year or so, but it's a useful tool for anyone who's interested in the probability. there are other Monte Carlo simulation software products on the market. Some of them are very successful, but very detailed and elegant. A little bit too pricey for me, but this will give you a general idea, of the likelihood of success for your strategy based on probability alone. Then,
Yeah,
and
it's been a while.
yeah, and then also down here. Okay, so yeah, so on this same butterfly strategy that I just now showed you, that that the probability curve is outside of the payoff curve. When you do the percentile calculations, this will give you the mean P&L, which is essentially your expected return. So for this strategy, with this probability profile, you're likely to lose 976,000. So if you did this trade 100,000 times, your mean P&L is going to be negative 976. So why would you do that trade? You never want to do a trade where your mean P&L calculated if you did the trade 100,000 times would be negative. You never want to do that. So anyway, I didn't mean to take up too much time, but this is a useful tool. And I did want to point out that I did use this when I developed the Weirdor. So this is the Weirdor and the Boxcar. So this is
the road trip too.
And the road trip, yeah. So this is not just a nifty thing. It actually has utility.
And I think we did a roundtable on this and had the author of that program on a couple of years ago. I'll see if I can find that and dig it out.
Yeah, we did. I've corresponded with him. And I mean, obviously the complaint that everybody has on this is that, well, this doesn't take into account any adjustments. And that is true. But it comes back to the original question. Do you want to take a trade where your probability of success is less than zero? Or I should say less than 50%, because then you're less than a coin flip. You might as well be playing roulette, which, as many people know, of all the casino games, you're the biggest sucker of all if you play roulette, because of the way, because of the math. And so, you always want to do a trade where your probabilities are better than a coin flip.
Oh, and I found that old roundtable we did, so I'll put that in the.
Oh, okay, yeah.
I put it in the chat, and also it'll be in the recording on the meeting links.
Okay.
All right. Well, I think that's it, Dan. We're coming up on an hour, so good time to stop. So
yeah, okay.
The boxcar continues on just like it should, and I was sad to have that big hole to dig out of, but I'm happy I'm back to ground zero. So.
Well, me too, and it's a lesson learned, and we've all been there, and I've been there. In fact, I've been there more recently than I care to admit, and I've just finally learned after years of thinking. They say doctors make the worst traders because we always think we're right about everything, and we can't accept. For doctors, the concept of probability. No, we're not buying into that, but you have to. And it's been a hard lesson for me to learn, but yeah, you don't want to dig yourself out of a hole. You can have a small hole, and you will have a pothole, but you don't want to be digging down to China and trying to throw that dirt out.
Right. So last question before we leave, how are your call credit spreads doing? Are you still doing those?
On the
boxcar?
On the boxcar? Yeah. Let's see. I
know you said Lynn doesn't like them.
She does not. I do have I actually have one on the August 19th. And it has a delta of 11 right now. So I suppose that one could give me some trouble, but it's not going to. I'm looking at the risk graph, which you should now see, I guess.
I do,
I'm
yeah.
looking at the risk graph. So this is where we are. And as I mentioned, I do not have, well, I said I didn't have a debit spread on, but I have this one. I guess what I was thinking, I don't have 1 4 down here, but that's because this is profitable and I'll just take my money out.
Right.
And as you can see, this is the one that I wanted to get on earlier this morning, but I have my order in at $1.65 and it's not going to hit that one. So I have to just wait another day because we're not going to, I don't think we're going to move up. And you know, this is the YM, which is the Dow futures. And as you can see, this is 7 o'clock this morning, my time. So this is the open, and you can see we've done nothing but move up. And I mean, a lot of times we'll reverse around 11 o'clock, but I don't think we're going to reverse enough for me to get that filled.
Yeah, it
Certainly possible.
looks like it's just going to hang out near these highs for me. I don't really see any movement later for the rest of the day.
Yeah. Yeah, I don't either. But you know, it's very difficult to predict the market. I think I recall the last meeting that we had here. You asked me what if I thought the CPI number would do much, and I said, well, it doesn't usually do much. Well, boy, was I wrong, huh? Because
Yeah,
we had the
well,
rally day after that.
well, it came in 0.2% below consensus, so everybody was drinking the happy Kool-Aid. Yeah.
Yeah, so I guess I should modify that, and that is that if the CPI number doesn't change much, the market won't change much. But if you have a really happy number, the market will react to that, as it obviously did.
Yeah, if it's outside the consensus, it usually will impact the market, I guess.
Right, exactly. Yep.
All right, Dan, I guess let's wrap it up. And thanks for everything. Thanks for everyone for coming, and we will see you all next time.
Right. Thanks a lot, Tom. Thanks, everybody.